Well, good morning and welcome to the Experian Quarterly Business Credit Review for Q4 2021. My name is Gary Stockton. And before we get started, I wanted to cover a few housekeeping items. If you would like to follow along, we've dropped a PDF of today's slides in the handouts area. We'll also include a link to the slides in our follow-up email. During today's webinar, we'll be discussing key findings in the Experian Main Street Report for Q4 2021. Our presenter today is Brodie Oldham, Vice President of Commercial Data Science for Experian. Brodie leads a team made up of consultants, scientists, modelers, and engineers with diverse skills who provide clients with leading-edge analytics-driven information solutions, services, and data visualizations. He writes and speaks on behalf of Experian about trends in credit markets. We encourage you to submit questions using the Q&A applet in the GoToWebinar tool panel. Your questions will be passed along to our experts and responded to following today's webinar. And now I'd like to turn things over to Brodie Oldham. Brodie.
Thank you, Gary. I am very excited to be here with you today and talking to some of the trends that we're seeing in the market. In doing that, we use our Experian commercial business credit data. It's data that includes information on payments, on inquiries, information on different types of credit products being used by our customers and by our small businesses in the U.S. economy. And we bring all that together to look for opportunities and risk that we're seeing over the next 12 months, and also to look back at our fourth quarter. And that's going to be our focus today. We're going to look at some of the trends that we saw in the fourth quarter, dig into a little bit more of our Main Street report, and that will highlight some of those areas of opportunity that I mentioned earlier. Now, when we look into what's coming up in the next 12 months, we're going to see risks from the Fed. We're going to see supply chain challenges that continue. Inflation will linger a little bit more into our 2022 year and even into 2023. We're going to talk about labor force engagement as well. And some of these are risks that we'll see over the next year, but we want to really start with some good news. And the good news that we're going to start with is our wage information. When we talk about the labor force in the U.S., what I would direct you to here is on the right-hand side of the chart that we're looking at is comparing unemployment rates to our change in the hourly wage that we're seeing for our labor force now. And generally that has been trending up over the past 24 months, continues to grow. One of the things that you'll notice here is that unemployment ticked back up as we got closer to the end of the fourth quarter. One of the things that's doing that, creating that tick up, will be people joining the labor force, coming back in. And as we went through the fourth quarter, we're coming out of the Delta variant challenge that we had with COVID-19. We were getting close on the rise of Omicron, which was the next variant version. We had parts of our labor force rejoining as they looked for opportunities, increased wages in the market. And they're really stepping back into that market in the fourth quarter. And so we saw our unemployment rate go back up. That's because of engagement with the market. So not a bad thing to see that. We'll continue to see that labor number potentially continue to drop into our first quarter of FY or in our first quarter of 2022. Now, one of the things when we talk about labor and the market is that the labor calculations that we see coming in are still lagging what we would see from pre-pandemic levels. And that means parts of our economy, industries such as leisure and travel, are still seeing that lag because so many folks came out of those industries. It's hard to come back, and especially with that wage growth that we're seeing across industries, some of that labor force has decided to change. And so moving to a new industry that may have a different skill set at a higher wage is a trend that we've certainly seen over the past few months. Now, when we think about the demand for workers, we look at employees or employers seeking to bring on those new workers, there's a competition there, certainly for the labor force. And you can say a person sitting in a seat right now at your business may be looking just across the street to change jobs. And so we've seen quits in the U.S. Certainly in an upward trajectory, as well as job openings. So those job openings are still there for people to say, hey, I can make a few more dollars across the street than I'm making here in this role. So I'm going to go ahead and quit my job and move across the street. So there is a lot of competition, especially as that wage pressure increases. And that's a big deal. So for small businesses that are looking to grow, competition over this labor force that is looking for a higher wage, putting people back in seats, getting those that are interested in a job moving forward to come in and fill the seat that you have is costing you a little bit more as a business owner. So it is a change in what we're seeing, and that will continue to move forward as we come into the first quarter. But in the fourth quarter, we saw that really at its highest point. Now, something else that's going to impact the labor market will be the migration of the labor force. And we've talked about this over the past year. Folks moving from higher cost areas, those areas in the Northeast, in California and our West, just where it's more expensive to live. House prices are higher. So when we talk about shelter, food costs, just a little bit higher in these areas. And so folks are moving into the central U.S. where it's a little more affordable. And especially during COVID, when there isn't a responsibility or much of an ask to be in the office, we've seen more of that transition to these areas. When we look at growth across, you'll see here the top 5 states where people are moving into. And that's important as we look at labor force and where jobs are being filled at this point. We talk about maximum employment. Right now, as we look at our unemployment rate, certainly for the fourth quarter, we saw that tick up to just around 4. And we consider that maximum employment. It means sustainable employment as we go forward. Now, that maximum employment number looks across the whole U.S. and may not look state to state. When we look at states where we've seen some of this transition of the labor force, what you'll see is that some states have a still outstanding need for people to fill jobs, but those people have moved away. And we see in other states where we have full employment, and I think there's 5 states at this point that have full employment or even beyond that full employment number. It's where people are moving to. So that will impact industries across the U.S. where you'll see some transition. So leisure and travel industries that we would see in California will have a little more trouble picking up that labor force that's needed, whereas you might see different types, or we'll see the mining industry, we'll see oil and gas pick up those that they needed in Texas and surrounding areas. So that regional view is very important when you're interested in staffing up, and especially when we look at lending into these markets from a lending perspective. What I'd also say here is that we're seeing more and more of the labor force move out of the core urban areas and into suburban areas. But with the ability to work remotely, you'll see more of that, those folks moving out into areas, certainly less expensive areas as they move out and about, but you'll see that transition out of the core urban areas. Something else that we'll talk about that's impacting labor at this point is COVID-19. We touched on it a little bit, but I think a good way to evaluate the impact that we'll see in future variants is to look across our historic trend. Now, from a labor perspective, when you look at this, you'll see it's pretty steady. We see COVID-19 pick up in the early parts of 2020. You'll see bumps here in the variant spread. You'll also see that folks are staying home from work a little bit more during those spikes. We saw that with Delta. We saw that certainly in the fourth quarter with Omicron. You'll see the big spike here in the fourth quarter. It's a big deal when businesses are looking for employees to cover during the holiday season for some of these short-term jobs, the openings, and certainly retail and wholesale filling in those spaces that they need for high volume times. And when we had a spike in variant outbreak, what you'll see is that more folks were staying at home, not engaging with the labor market, and so we saw a rise here. We could continue to see this through the next year as we see additional COVID variants come out. And the expectation is to do that. Small businesses are really setting themselves at this point, knowing that more variants will come out in the next 12 months and seeing this trend that we saw in the fourth quarter with Omicron. They're setting themselves to be prepared for these spikes and to make sure that they have coverage to keep their businesses open and running. So when I take a look at another key topic, so we've talked about labor. I think inflation, as we see inflation continuing to move in the upward direction. We see upward pressure on inflation continuing, both in our overall CPI as well as our core inflation number. We're up around 7.5% coming out of the fourth quarter. We hit that certainly in January. What we're really seeing with inflation is that it's putting more pressure on the Fed to take some action to bring that down. Inflation at a 7.5% number, we look at the things that are here and will be big stories in the next 12 months when we look at food prices certainly escalating and gas prices, continuing to move up. And we even saw more of that pressure hit outside of the fourth quarter into the first quarter of 2022. But certainly here, when we look back from our reporting and what we're seeing as we close out 2021, you'll see those gas prices just steady right before they pick up. And certainly with some of the conflict that we're seeing now in Ukraine, that we'll see potentially spreading to other regions, we're going to be watching this very carefully. Now, what does this mean to the U.S. and what does this mean to our consumer and small business owner? It means that prices for these very important tools, certainly gasoline and transportation and the moving of products around for inventory will go up. Where we see it from a consumer's perspective is that consumers are going to be impacted at different levels. It doesn't impact the consumers all the same. So we're going to have different segments of the population that are impacted more. Those that rely more on these certain goods that are that are staples in their life. So if you are in a low income segment, what you'll see is that there's higher pressure. What are you buying more of? You're buying more of food. You're looking at how your shelter is. Are you able to accommodate rent or payment on a home? Is that going up? And what we're seeing is that those certainly will impact our lower income segment. Now, as we go into the next year, we're going to see some resets that'll impact all segments, and that's already starting to happen coming out of the fourth quarter. So when we look across inflation as a whole, we look at how the Fed came out in December, looking at the trend that they expect as they take on some action going into our 2022 year, and they look at the ways that they'll evaluate their purchasing activity, what they have on their balance sheet, also the way that they look at rate increases over the next year. And you're going to see some of that action as we got into, or as they're thinking about 2022. This inflation rate generally is outpacing what their expectations are. They're basing most of what they're considering on the Omicron variant and on COVID-19. And that's how they'll view trends in inflation as we go forward. Some of that does play into where we'll see the rates go over the next year as it ebbs and flows. But there are some other things that will play into inflation. Certainly supply chain challenges that we're going to see over the next year continue to linger. And we'll also just as we look at some of the tightening activity, there will be some consequences in that as well as we go forward. So I think we'll see that the rate increases will begin probably late March. There is talk of that going to about a 0.5% change, some push for that. But I think generally, as we look back historically, we saw as the fourth quarter came about, the consideration really there is to go at quarter percentage point increase each time we look for an increase from the Fed. That's the expectation that we see generally from the Board of Governors as we go forward. But as the economy picks up and as they look at how to control that inflationary number, we may see them be a little bit more aggressive, certainly on their first increase. But we'll see as we go forward in the first quarter. So let's look at consumer confidence. So how has this been impacted by labor force changes, wage increases, price increases as they come about? One of the things that you'll notice here as we look at a University of Michigan study, you'll see that or survey, you're going to see that consumer confidence is on the way down, and it's been on the way down really since the summer of last year. And we're seeing that as inflation started to pick up, our economy's heating up. That's great news. GDP is on a pretty stable trajectory. And so our country in general is returning back to normal. And so we're not going to see much variation there. It really is how consumers are perceiving and the trust that they have in the Fed's actions as we go forward, as that will drive that consumer confidence back up. You really see that cross where the trends really hit, where we look at consumer confidence beginning to really drop off as those prices go up. So inflation is impacting consumer confidence. One of the interesting things that I'll draw your attention to on the right-hand side of the slide is a scatter plot looking at what we would say are the consumer confidence points. You'll see that in the blue lines and in the blue dots here on the screen during certain periods where we saw inflation ebb and flow. You'll see that our inflation rate across the bottom, and right now we're in the fourth quarter around 6. We went into about 7.5% starting in January, and the first quarter as we're coming out of the fourth quarter. What you'll see is consumer confidence is pretty low here, even as we see our inflation rate go up. Consumer confidence is lower than we would expect. We really expected that small dot to be a little higher and not be so low. So I think there are other factors here that are impacting other than inflation, and we certainly see that in the supply chain challenges that we see. Certainly not having different items on the shelf can impact confidence. We'll see that prices are eroding some of the wage gains that we've seen for consumers, and so some of that is playing into this consumer confidence feeling across the market, and that's certainly going to impact commercial confidence as well in small businesses. So what I would talk about here is we're still thinking about consumers, and the reason why we talk a little bit about consumers in a small business evaluation is that consumers are really our engagement with small businesses. They are spending, and they continue to spend as much as they can. The $2.5 trillion in savings that they had over the last year, built up from both stimulus and opportunities to save a little bit more, put a little more cash in their pocket. But as inflation grew and our supply chain challenges hit, we see that it's going to impact consumer spend. It's also going to have some impact on small business owners. Are they going to be able to draw as much out of extra capital or equity that they have in certain assets to be able to push it forward to keep their business running when they get into some of these lean times? What you're going to see here from a consumer's perspective is that unsecured lending continues to be very strong as we come into the fourth quarter. That's good to see. You'll also see at the top auto and mortgage lending products dropping off. As expected, with low inventories, you're going to see those numbers drop. What that is still doing is you're still going to see those shelter costs going up. You're going to see equity in homes continuing to rise with the inventory shortage. What that helps from a small business perspective is that you'll have increased equity to pull out. Now, some of the things that you'll also notice in the center chart is that forbearance activity has slowed and continues to slow in the fourth quarter. We'll continue to see that in the first quarter of this year into 2022 as well. But in the fourth quarter, that was slowing to a point. What you'll notice also in the very far right is that delinquencies are starting to pick up. Now, those delinquencies pick up as we see expanded push into growth in lending and unsecured lending, certainly from our credit marketplace. as they dig deeper to grow, and as consumers are feeling more confident in or less confident in what's going to be available soon, and their confidence goes down, they may reach out to pick up a little bit more credit, just to make sure that in the lean times they have enough to buffer with any challenges. And certainly with some inflation, we'll get some pressure here as consumers are out searching for additional credit facilities as they go forward. Now, when we look at commercial confidence, so we talked about consumer confidence being lower than expected, a little bit of a bleak outlook when it's certainly that low. What will follow that will be small business and commercial confidence. So how do our business owners feel as they come into these times where consumers are not feeling as sure as they could within the market? So small business index that we are tracking ebbed up a bit in the fourth quarter. We saw that with the supply chain coming through in some areas, allowing the inventories to be built. Small businesses and even some of our larger business were able to find workarounds for inventory and get those onto the shelf. It made them feel a little bit more confident there. We had the Biden administration also provide some guidance to ports and help those open up a little bit more. So we saw that confidence level build. So that's great. In January, we saw a little bit of a drop off. So that's following that consumer confidence number. So as they ebb and flow together, you'll see as consumers worry a little bit more, you're going to see small businesses do the same. But what's really creating some of the, besides that consumer impact in the sales, is that really what's driving this commercial confidence number? So if we look to the right, we see another survey where it evaluated, and it certainly does. Consumer confidence plays into it in the spend that's available there. But what's really important for business owners at this point? What are they thinking about? What are they worried about as they go in? How can a lender help them to feel more confident or offer the right product at the right time? So when we think about small business owner needs at this point, we certainly think about inflation, cost of inventory going up. They're trying to keep the prices as low as they can. Those margins shrink, but they have to push at some point, and that needs to be, or is starting to be, pushed out to the consumer as well. So that's a concern. The other two big ones are labor, and we talked about that, a little bit about how hard it is to get people in seats, people there at the register, folks serving and being part of that services industry, how to get those folks in there. I think that's a challenge. And certainly in a wage increase market, how to get people to stay. And labor quality is certainly a challenge for businesses as they go forward, and certainly looking into the next 12 months, looking at how they'll continue to support their business and keep those folks in seats and not look for opportunities to maintain a level of attrition that is acceptable and will keep their business running. So that's very important to small businesses at this point. Now, when we look at what support has been given from a stimulus perspective, so we've talked about, what are some of the things that could help with consumer and commercial confidence? We had our infrastructure bill passed toward the end in the fourth quarter. We had a social spending bill that was also there that would have provided additional stimulus into both the consumer and small business markets. The infrastructure bill did pass, and as we look for that to be handed out, that will help some small business in certain industries to pick back up, and some of those delinquencies that we've started to see out there be tampered a bit. Our social spending bill is on hold at this point. Certainly with inflation going up and some of the challenges that we're seeing within the market, that's on hold at this point, but it could have potential to move forward. As we look at that, it's on hold. And so some of that money that was held out, certainly we're going to see some of the impact as we go into different industries where they're potentially waiting in the fourth quarter for that funding to come through. And that's impacting some of their early stage delinquencies. Now, let's look at this from an installment lending perspective. So if I'm a small business and I'm looking to create just some cash flow for myself, have that bit of cushion, buy a piece of equipment, how's that lending going at this point? And I would say that customers, as we look at from a lending perspective, continue to reach out to lenders for these type of installment products. One of the things that you'll notice here is that the value, the lines are continuing to increase for these installment type loans. You'll see that the number of the volume is continuing to increase. That's certainly good in the fourth quarter to see that expansion happen. Even through a wave of COVID-19, we still saw lending increase and grow. So that's a good sign for us for the economy continuing to be strong even through some of this ebb and flow. You'll see that underwriting policies for lenders into small businesses remain pretty stable. So that's a good sign. We're not seeing any switches or levers pulled when we look at the types of products that are available to the market. There are no tight recessionary policies in place to tighten up credit. So at this point, it's still open and very stable. Delinquencies continue to head down, and that's certainly good. Now, we're seeing a little bit of a tempered origination volume here. Some of this is from the buy now, pay later products that are in the market. You'll see that those are increasing. Money is getting out to consumers and small business owners as they're trying to inject some capital here into the system. And so needing a little bit less of that installment type of a product going forward. But again, an opportunity for additional capital is certainly open and flowing for small businesses as they go into the fourth quarter, ending out in the first quarter as they continue on. As we look at how that compares, I like to do this because I think it's important when we look at delinquency behavior. We see it trending down. We look at seasonal spikes that we see toward the end of the year, and we saw that on the short-term lending on the previous slide. What you'll see here is that year over year, when we look at these different tranches of loans as they come in, really talking about year over year, what are we seeing as far as performance? In this sloppy pay kind of range, when we look at 1 to 30 days, that means there's a holding back of repayment. There may be a little bit of a late payment trying to catch up as cash flow gets a little tight in some areas, as Omicron picks up. Delta was in the middle of the year as we saw this ebb and flow in the availability of consumers coming to the storefronts or digital storefronts. You would expect that delinquencies would rise. But what we saw over this year, over 2021, as you can see that delinquencies stayed pretty low. We had just enough stimulus in there to keep us through the year. The economy was growing at a good pace. And so even for this type of early stage delinquency, we saw that it was a good year for us as far as keeping delinquencies low for the small business. A lot of funding was available there to keep them in the green. Now we look at 60 and 90-day delinquencies, a little bit more pickup toward the end of the year. We look at the pink line moving across. That's our 2021 trend. Again, still coming out at the end of the year below where our expectation would be because the market is moving along so well. So good news there, certainly comparing us year over year. Now, when we look at industries, what I'll direct your attention to here is that we're seeing that there are some industries that are impacted more than others, certainly looking at installment lending. So these are some of the bigger loans that companies would go out for. Mining is impacted a bit here. You'll see those severe delinquency rates coming in. We're coming into that fourth quarter. What you'll see in the fourth quarter is that there were some lease renewals coming up, certainly for the oil and gas industry, that included, just some decisions from the U.S. just in general to move to more renewable policies. And so there was some just volatility here. I think as we get into the first quarter of 2022, we're going to see a bit of a reversal on this as, some of these oil and gas mining companies kind of pick back up some pace to cover some of the gap that we have from international imports. We'll see some of these industries kind of pick back up and a reversal in the delinquency trends that we see on book at this point for this type of industry. You'll also notice that I highlighted public administration. So that's another one looking for the social spending bill to come out. There were some delays in payments, hoping that that stimulus would come through. Also, we're entering into the budget season and looking at end of year, what's left to spend. And so as we look at some of these industries, you'll see some, just from a seasonality perspective in the fourth quarter, you'll see that public administration picks up some more of that short-term delinquency within the portfolio, but that should again see some correction in the first quarter. Now, when we look at unsecured lending, and I think this is a good trend as well to see. You're going to see some increased velocity here in the number of loans being put out. Again, small businesses looking for that opportunity to pick up unsecured private lending. The stimulus has kind of run out at this point. They're looking for opportunities to just pick up some of the cushion there. You'll see that the balances or the line amounts have gone down a bit. And part of that is because you'll see that a lot of newer businesses are coming into the market, and so they're being offered lower rates. You're going to see an expansion of fintech lending that will, again, look at these revolving types of products into the market and put them out there and, again, have lower rates just as they're engaging some of these small businesses. We'll still see underwriting very stable here. You can certainly see it in the bottom right corner. Delinquency rates are low. You see a little bit of a tick up here in our western region or in our southwest region. But again, a lot of that is seasonal. We should see some of that correction occur as we get into the first quarter. When we look at these different trends, what we will see again in 2022 is some lingering effects of inflation that will strain small businesses a bit, and they'll look for these opportunities for unsecured products as they go forward. We'll also see supply chain challenges. You know, we talk about it being a quick fix and it's opening back up. That doesn't mean that it's going to be a total free flow of the supply chain and getting inventory from offshore through our ports and to our warehousing and ultimately to the end consumer. It's not going to be a fast fix. So we'll see that linger through 2022 as we work on different ways to adjust the process and maybe even a little bit into 2023. So don't expect a quick fix there. But again, you're going to see these different parts or different industries reach out and look for additional funding as we go forward to keep their businesses afloat, even if we see low inventory numbers continue. Now, what you'll notice here, I wanted to call that out when we talk about supply chain. I want to look at these industries year over year and really focused in on manufacturing. So getting those core commodities into the core building blocks into manufacturers here in the U.S., building the products, getting it out to wholesalers, getting it out to retail, and ultimately to the end consumer. You're going to see a bit of a bump here year over year, really caused by those supply chain challenges. Also by labor force. So if you aren't able to get people into those warehouses, people into the trucks to move the product across country, you will see some challenges in these industries as far as being able to reach their goals and meet their obligations for repayment. So a little bit more pressure here in the fourth quarter when you see the delinquencies rise. But again, as we see the infrastructure bill kind of come out, we see opportunities for the supply chain to loosen a bit here and get the flow going. We should see these delinquencies slowly return to their normal level delinquency rate. So that's good. You know, as we look forward, we have a very positive outlook on where this will go into 2022. Not fast, but it will move in that positive direction. So this is a good opportunity too to talk, you know, as we talk about lines looking like they're going down across the U.S. We look at the innovative spark that we're seeing in small business owners. They're coming out and building their business, whether it's a real estate business or they're opening up a new restaurant or doing some type of online retail type of a new business. You're going to see people really that have been outside of the labor force stay outside of the labor force. So that could be some of the pullback that we're seeing in labor. People starting their own businesses during the pandemic where they weren't able to go to work. Now they've started a new business. Now they're going through the application process. We still see applications high above 400,000. hitting every month. That's really above the norm, significant there. But that does impact our labor force with these folks not going back in and participating. We're going to see this level continue of business applications through this year. So it's really exciting from a U.S. perspective to see all these new businesses kick in and really do some work here to bolster and improve our U.S. economy. What does that mean for a lender, though? What it means is that you're going to see over 40% of small businesses or businesses that are operating within the U.S. have less than a year on book. So generally, our lenders are out there looking at least 2 years of history on a small business before they'll engage them with a standard or traditional product. A lot of new offerings are coming into the market, certainly with buy now, pay later for commercial. We're seeing products that look at newer businesses, even minority focused small business openings, and offering funding into those that are less than a year old to kind of get them up off the ground and get them working. So as we look at traditional lending, I know there's a lot of movement out there to look at businesses and evaluate risk a little bit earlier in their process, moving from a 24-month really cut off on a traditional product to something more around the 12-month stage. So when we see all these new businesses out there, that's a lot of opportunity, a lot of growth opportunity as we go into 2022, and we'll continue to see that grow in the fourth quarter, higher than it's ever been. We're going to see that continue into 2022. So as we kind of wrap this up and we look at what we're seeing from a macroeconomic perspective and from a small business perspective, know that COVID-19 is still we're going to see variances. We look at influenza, we look at other outbreaks, we see this ebb and flow, but it lasts for years. It's not one and done out over a year. We get some vaccine in market and it changes everything. We'll see variants continue to ebb and flow for the next couple of years. But I think small business and consumers are adjusting to that and know that there will be these variants. It has less and less impact on the markets and market performance as we go forward, even as we see these go out. So thinking about our vaccination across the U.S., we're up around that 70-75% already. So that'll continue to improve as we go forward. But certainly something that will have a small impact on what we're doing. I think the more headwinds will come from our supply chain and inflation, certainly from international trade as we go forward, and some of the conflicts that we're seeing across different regions. So that'll have some additional impact on us as we go into 2022. Inflation, again, will continue to linger through the year. The Fed is going to take some opportunity to do some rate increases, probably 2 to 3, potentially 4 through the year, starting with 0.25% increases as we go through the next couple times, maybe 0.5% on the first bump that we see. They'll look in March to see if they start bringing down their buying activity, how they start releasing some of their balance sheet. But I think that's a longer term discussion as we go forward. So they may hold on to that for a little while, depending on the pressure, the upward pressure that we're seeing within the market. New businesses are certainly growing at a great clip. We like to see this innovative spark and new business entrepreneurship within the U.S. So that's certainly a value add to all of us. What is important for our lending community is to really focus on some of these newer businesses, see how we can address and prop them up and get that funding into their hands so they can continue to expand and grow and keep our growth opportunity for the U.S. In that upward trajectory and certainly in a positive state. I think we're all doing very well as far as an ecosystem. We're going to see, returning to a bit of normality as we get into the first quarter of 2022. There will be pressures that come across that we'll be facing as we get into the end of March and into April of 2022 that could impact just normal day of business. But I would say from a U.S. economic perspective, we're still in a good trajectory, not seeing recession in the models that we're looking at, very low percentage there of the potential for recession. So in good shape for small businesses to keep moving forward and for those of us that support that ecosystem to keep driving forward as well and supporting them and keep on this positive track. Well, Gary, we'll certainly look for any questions that our listeners have.
Yes, so if you have questions for Brody today, if you could submit them through the GoToWebinar application, and we will certainly be routing the responses back to you after the webinar today. And I want to thank everyone for joining and watching. I hope you found these insights helpful. Please remember to take a moment to answer our short survey as you exit the webinar. It really helps us refine and improve our quarterly webinars. For more information on Experian Business Information Services and products, please go to experian.com/B2B. I want to thank you, everyone, and have a good day.